All right, it's 8 o'clock. I'm going to get this thing started so that way I can kind of keep this short for all you guys. First of all, I'd like to thank you for coming out this evening to learn a little bit more about the pension. My name is Jonathan Wicker. I'm going through the list and seeing everybody who's registered. I see, some of you guys I know, some of you guys I don't. So I really appreciate you guys taking the time and coming out to learn a little bit. The way I'm going to break up this webinar this evening is I'm going to talk a little bit about in the beginning some of the things, some of the benefits, some of the ideas to consider when you are getting ready to retire. And then the back half of the presentation, I'm going to kind of dig into the actual specifics of how the pension system works in New York State and some of the details behind it. If at any point you have any questions or anything that you want to bring and address to me, there's a section to do questions off on the side. Feel free to pop a question in there. I'm going to try to get to them as we go through. Otherwise, I might wait until the end if there's a bunch and then answer them on the back end. So first of all, again, thank you guys for attending tonight. I'm going to get started on this. All right, so first we have to do our friendly disclosures, which everybody loves. And what this is going to basically say is that Lincoln or none of it's affiliated. We're not affiliated with NYSTRS. We're not endorsed by them. This is just me working in the school districts on the island for the last 14 years, wanting to get more education back to the employees because everybody comes in, especially from the investment providers perspective, and talk about the 403B, but nobody ever tries to educate you guys on different topics and different things. So, that's kind of where we're coming in from this point of view. Lincoln, we've been working with teachers for 52 years. We've worked with a ton of teachers on the island. Every single school district that got these emails are districts in which I work in. So if you have any questions on that, we'll be doing a presentation next month about the retirement accounts and all that stuff. Let's talk about the pension tonight. All right, focus on your retirement. So this is a nice little chart that kind of gives you guys some ideas. What will my savings cover in retirement? How can I make the money in retirement last? How much should I save each year? And how much do you need to save? These are all questions that a lot of my clients were starting to address with them and trying to come up with game plans. Some of the big questions are medical expenses and, paying the mortgage, or you might still have a kid or college and you're considering how to pay that in retirement. So those are all conversations with a lot of advisors that you can talk to and try to strategize in terms of, what makes sense for you guys and what that number that you guys are trying to get to retire to be comfortable at. All right. In retirement, most clients that I deal with have these three options. One, Social Security. Granted, depending on your age and when you retire, Social Security might not be a benefit that comes into your life right away. For me and my generation, we'll see. I'm not quite sure about Social Security, but hopefully it'll be there in some semblance of a fashion. The second is the pension through the school district and the 403Bs. And then the third option after all that is any personal investments that you have outside of the retirement accounts. All three of those kind of create this three-legged stool where it all kind of funnels in and gives you guys different incomes to consider when you guys retire. Social Security, the pension, the retirement accounts, or personal investments and savings that you have maybe in the bank. Biggest issues. There are some that are more prevalent than others nowadays. Longevity, most clients at this point, and I think I have a slide that comes up that kind of shows you how long life expectancies are, but people are retiring with 30 years at 55. They're living into their 90s. That could be 40 years in retirement on that one pension that doesn't really change much, and I'll talk about that in a little bit. Taxes. Taxes are becoming more and more of a conversation. I know with a lot of my clients in the districts, we're talking about the Roth 403B, so that way you guys can save money and have it be completely tax-free in retirement compared to the traditional 403B where you guys have to pay taxes upon withdrawal. So what's the tax implications when you guys retire? Inflation. So I've been using this analogy for the last 14 years, but a teacher retiring today on $60,000 a year, what was that $60,000 30 years ago? It was a whole heck of a lot more than it is today. That's the inflation piece. You guys are going to retire. You're going to get a pension. It'll be a fixed number. But what is that number going to be 30, 40 years from now? And will that number be able to still pay the bills? Market volatility, all about the investments. And number one thing that is coming up in all of my retirees conversations is health insurance. Will I have enough money to pay for my health insurance in retirement with whatever the district, you know, whichever district you work in and whatever the agreement that you have through the unions? Will I have enough money? Will I be able to pay my living expenses and my health insurance benefits? Because that's the biggest wild card right now for a lot of people is health insurance costs just keep going up. The cost of insuring people just went up. I just had a baby last week and I called the insurance company and found out how much it is to add a baby onto my health insurance, and I was a little upset about that. It's crazy. So that's definitely a part that people are considering into retirement too. And there's things that we can talk about after this presentation if you have questions on that. Other concerns, as I said, health insurance, life insurance, long-term care insurance. God forbid something happens to you and you go into assisted living, or you need somebody coming into the house, or go into a nursing home. Estate planning. Just an FYI, the long-term care and the estate planning, I will be having a webinar in the fall, probably around October, November, where I'll be pulling in a elder care attorney to talk about those issues and things for you guys to consider in addition to the pension. So I got you covered. I got a whole bunch of other plans coming down the pipe. Life insurance planning, as I said, create an estate, review the policies, legacy. Are you trying to leave money to kids? Trying to maximize your pension? All good things. Other things, as I said, the long-term care. How are you going to pay for nursing home or assisted living expenses if you need to? These are all different options that we can talk about another time. All right, here we go. At age 65, there is an 80% chance that you're going to live to 80, 65% chance to 85, 40% chance to 90, and 21% to 95. That's if you're age 65 now. So by the time, you know, if those of you guys that are on this that might be in your 30s and your 40s, those percentages are definitely going to be even higher to get out to 95 and 100 and who knows how long, just based on medicine. Estate planning. If you are considering retiring, review your beneficiaries on all your retirement accounts, on your pension. Make sure your wills are up to date, your power of attorneys, your living wills, your healthcare proxies, all things to kind of consider before you retire to make sure you get all your ducks in a row. All right, working with a financial professional. There's my one plug. All right, so sorry about that. Any questions, you can always talk to me or any advisors that you might be working with. Retirement analysis, you know, projecting out. So if you're getting close to retirement, a lot of the clients, I do have clients on here that I actually see, and I know you guys are on here, where we've run the scenarios, we've run the different benefits of the different pension options, and kind of started to come up with some ideas in terms of what is going to be the best scenario that fits your family and your lifestyle. So definitely have those conversations too. All right, let's get into the pension. Funding your pension. So currently right now, there are a whole bunch of tiers. I don't know if there's anybody still left in tier one, which tier one was June 17th of 1971. If you are still teaching and you started teaching before 1971, go home. I'm kidding, but retire. After 1976 to 1983, so anybody after 1983 is tier four. That's the vast majority of people now still working. So this is going to go over basically tier 4, tier 5, tier 6, and explain some of the different tiers that you guys might be in, and I'll explain that. So first of all, if you are a tier 6 member, tomorrow when you go into work, make sure all the tier 4 members, the older teachers, are thanking you for your contributions, and I'll explain that in a minute. So to fund your pension, you guys every paycheck are putting contributions. If you're tier 5 or tier 6, you're putting contributions into the pension system to help fund it. In addition to your contributions, New York State's also kicking into it, and the employer is kicking into the pension system. So it's kind of like a three-pronged attack where you guys, the state, the employers, are all funding the pension system to make sure that the New York State pension system is solvent. I will go on out there and say this, that last I remember, and I did the check on it, New York State's pension system is one of the strongest funded pension systems in the country. It's a great pension system, rarely ever has any issues. It's not like other states that you always hear in the news. They do a very good job managing it for you guys. All right, what are the differences in the tiers? Tier 3, all right, those are my old school guys. All right, I have a quick first question. What year is Tier 6? Anybody who was hired after, I want to say it was January 1st, 2012. So if you were hired after 2012, you are Tier 6. If you were hired between 2010 and 2012, you're Tier 5. So I'm hoping that answers your question for you. All right, I'll get into the contributions. So all of my older teachers are more senior or more experienced teachers. I don't know. You guys are probably making fun of me now. But any teacher who was working in the schools and was in the pension system prior to 2010, you are going to be retiring as a Tier 4 member. The nice thing, at this point, none of you are contributing into the pension system. It's been 10 years. It's been 11 years, actually. So the old rule was on Tier 4 is you contributed 3% of your salary for the first 10 years or accrued 10 years of total service, whichever came first. After you had 10 years of service in the system, you stopped paying. You were done. 3% came back to you, and it was your money to live off of, and you never paid a dime into the pension system again. 2010 comes along, and they decide to kind of switch things up, and they come out with Tier 5. Tier 5 is structured where you guys are contributing 3.5% of your salary for life. All right, where the old one was 3 for 10 years, the new Tier 5 is 3.5 for the rest of your careers. Not as bad as Tier 6. So if you're Tier 5, be happy. Tier 6, they bring you in, and depending on what your income is, dictates how much of your salary you guys are going to contribute. So as you can see on the slide there, if you make $45,000 or less, you're 3%. If you make more than $100,000 to the maximum of the governor's salary, which God knows what Cuomo's making now, but you're paying 6%. That's the max out, is that 6%. Most teachers who are starting out, you guys are looking at this, and you guys might fall into that 55 to 75. You're paying 4.5%. All these numbers are for life. I know that hurts. I apologize. Don't yell at me, but it is 4.5, 5.75, or 6% for the rest of your life paying into the pension system. This is why I joked around and said, those of you guys who go into school, into the building tomorrow, and you see those Tier 4 teachers, make sure that they say thank you. Make sure that they know that you are paying their pension, because in essence, that's what these changes to the pension were. Tier 5 and Tier 6 came out, and they wanted you guys to pay more into it for the rest of your life to help fund the pension on the teachers that were already retired or about to retire. All right. I had a question that came in. Is this for New York City pensions only or New York State? So the rules basically are the same. Actually, they are the same for New York City and for New York State. New York City has the New York City Teachers Retirement System, not the New York State Teachers Retirement System. It's a little different. There is some caveats in there where you have a 55-25 clause, which I'm sure a lot of you guys wish was out in the state system. But there's some different little nuances, but the calculations and the contribution amounts are all the same, regardless if you're in the city or if you're in the state system. So awesome question. I like that one. Also, thank you for saying congratulations on the new baby. I'm not getting any sleep. I'm a little delirious. So, but all right. So let me get back to this for you guys. All right. How do you guys calculate your pension when you retire? This is the biggest piece. So all of you guys that are Tier 4, all right, that's a lot of the teachers still at this point, but anybody who's considering retiring in the next few years, you guys are either Tier 3 or Tier 4. The way it ends up working, and I've actually yelled at clients, that you have to have 30 years and be 55, or have 20 years of service and be 62. Those are the big milestones. Those are the big numbers. So I've actually had clients who have been 55 and have had 29 years, and I legitimately yelled at them to suck it up for one more year because it's a huge difference. So what the differences are is anything under that 30 years or under the 20 years, you get 1.66 times your salary for each year that you work. All right. So once you get to 20 to 30 years, you get 2% for each year that you work. Simple math. You make $100,000. You work 30 years. You get 2% for each year that you worked. So 2% times the 30 years is 60% of your salary of the 100,000. So when you retire, you're going to walk away with $60,000 in your pension. Those teachers that I love you guys that have been there for more than 30 years, once you get to the 60%, every year that you work in addition to the 30 years, you get 1.5% for each year. So you don't continue to get 2% for each year. That would be nice, but they give you a little bit of a reduction. So if you work 34 years, you'll have 66% of your salary when you retire at that point. All right. That's tier 3, tier 4. Tier 5, they tweaked it a little bit. So not too much differences, but if you work less than 25 years, you get 1.66%. Once you get to 25 years, then at that point, you get the 2%. All right. So a little bit of nuances, a little bit of differences. And I think, did I put it in here? No. There's a slight difference also. Instead of 55, you have to work to 57, I believe it is. And then same for tier 6. You also, you can see the little tweaks there on tier 6, where less than 20 years, you get 1 2/3 per each year. For 20 years, you get 1.75. And then if you work more than 20 years, you get 35% plus 2% for each year above and beyond. So it is a smaller pension than tier 4. It is not as generous as tier 4 is. So that will get back to my other part is if you are a tier 6 teacher or employee, you're going to have more responsibility on yourself to save up some money for yourself compared to the tier 4s who will have a higher pension, even though they might have worked the same amount of years. All right, it's not a fair system, but it's just the way they did it. Sorry. All right. The calculations. You take your pension number. So let's just say you work 30 years and you got 2% for each year, 60%. You multiply that by your final average salary, which is your highest 3 consecutive school years in terms of your income. Generally, unless something changes medically or something like that, it's the last 3 years because you guys are always get your steps. And that's how they calculate the pension. So the years and the salaries are the biggest numbers. Those are kind of the biggest factors in there. All right. When you retire, what do we do? How does it work? All right. So basically, you have generally four options when you guys retire. There's the maximum option, there's a pop-up, the survivor option, there's a pop-up option, and then there's a guaranteed option for you guys also. And I'm going to go into each one of them specifically, so that way you guys can see them. And just also take a second and check any questions here. All right. I'll get back to them in just a little bit, I promise you guys. All right. So the maximum pension. The largest benefit you can retire on. In my years of doing this, one of the things I've noticed is if you're not married and you don't have a spouse and you retire and you're like, if I die, who the heck cares? Because this is my money. Most people do the maximum. Another option is people will take the maximum and maybe buy a life insurance policy, and I'll explain that. But bottom line is that $100,000 scenario where you make $100,000, you work 30 years, you get $60,000. In that scenario with the maximum option, New York State will come back and say, here's your $60,000, enjoy your life. Now, if you were to retire, or if you were to die and you take the maximum option, your pension is gone. So let that settle in for a minute. There is no benefit, there is no beneficiaries, there is nothing. You take the maximum option, you live a couple of years into retirement, and then God forbid something happens and you pass away, the money is gone. All right. There is a small death benefit. If you guys look in the bottom here, that if you, in the first year, you get 50% of the death benefit, which is 3 times your salary. The second year, you get 25% of 3 times your salary. In the third year and beyond, you get 10% of the death benefit for you. For those of you that don't know this, which again, I've got people who don't know this, if you die and you pass away in service, there is a death benefit to all teachers who are working and they have at least 1 year of service. You have to have the 1 year. I recently just had somebody pass away who worked in a school and didn't have a full year and didn't qualify for the benefit. But as long as you've worked 1 year in the school district and you pass away while working, New York State Teachers Retirement System or ERS, Employee Retirement System, will pay your beneficiaries 3 times your salary. The first $50,000 is tax-free. The remaining amount above and beyond the $50,000 is taxable, and most people at that point just roll the money over into like an IRA or a retirement account, so that way they don't have to get clobbered in taxes on it and pay the taxes on it. All right, let me open this up. All right, so that's maximum pension option number 1. All right, go back to some questions. So at 30 years at tier 4, I would get 1.5 for each year. No. So if you're tier 4 and you work 30 years and you're 55 years old or older, you will get 2% for each year that you worked. All right. If you have 20 years in, but you're not 62, is there a penalty? Yes. Instead of 2% for each year, you get 1.66%. That almost equals about 20% or so deduction. You don't want to do that if you don't have to. Now, granted, if you want to retire, you can retire. But if you are close to the 20 and 62 or the 30 and 55, stick it out. Stick it out for a couple of years and get that nice benefit. If you're younger than 55, will you get penalized less than 2%? Again, yes. If you retire and you don't have the 30 years and you're under 55, you only get 1.66% for each year that you worked. Hopefully all that's making sense. Cool. All right, so this is the maximum option. So as I said, a lot of people do take this option because they just want to get as much bang for their buck, and then they don't really care if they pass away, because they don't really want to leave this to anybody. They want the money for themselves. Or as I said, some people will take the maximum option and buy a life insurance policy because you're making more money, and then leave that as a tax-free benefit to one of your beneficiaries. That's if you guys are considering that and you guys have questions on that. Again, that's something that you can always email me and text me on or call me on after. All right, survivor option. This is one of the popular ones for many of my clients that are married. So what this allows you guys to do is basically, instead of $60,000, and again, do not quote me on these numbers, but I'll give you some scenarios. Instead of $60,000 a year, they might come back and say, we'll give you $52,000. And if you pass away, your spouse or your beneficiary will continue to receive that pension for the rest of their life in addition to your life. So it's a very beneficial piece for people who have spouses or younger kids and they want them to be taken care of. Granted, one of the biggest things is this piece right here. The beneficiary's age has a huge impact on that pension calculation. So if you're leaving this money to a 20-year-old, you're probably not going to get 52. You might get somewhere in the 40s, because the likelihood that you pass away and that beneficiary is still alive and they got to continue to pay that out for many, many years is pretty high. It's all actuarial tables. It's kind of geeky, but the older the beneficiary, the more money you get. The younger your beneficiary, the less money you get. But as I said, the nice thing about this is that if you do pass away, whatever your pension was will continue to be paid out to your beneficiaries, spouse, children, whatever. All right. So it becomes a very, very popular piece from a legacy point of view and from an income point of view, because if your spouse doesn't really have much income and you guys are dependent on this pension and you pass away, you know that your spouse is going to continue to get that pension and be able to pay their bills. It's something you can plan around. Your benefit will not change if you survive your beneficiary. So that's another big thing. If your beneficiary predeceases you, you don't get a benefit. That's the next option I'm going to talk about. All right, so this is only for you want to leave your pension and give it to somebody else. As I said, it's not as much as the maximum. It is definitely a lesser pension benefit that you will receive. Pop-up. So this is a fun one. This is an interesting one. The payment is lower than the maximum, similar to the survivorship option. You can name one beneficiary who cannot be changed. That's the caveat. So if you retire and you do a pop-up, you got to make sure you like that person. The age and the beneficiary also, as I said before, that dictates how much of a reduction in the pension from the maximum that you'll get. If the beneficiary predeceases you, your monthly payments go back up to the maximum. Pretty nice. All right, so scenarios where this might come in is you're retiring, you've got a much older spouse, and you take the pop-up option where you get this, and then when the spouse passes away, you get bumped up and you get a pay raise, unfortunately, because your spouse or whoever passed away. So this is a unique piece where you can do this. I've also seen pop-ups where there are different percentages of the pop-ups where you can do a little bit less or a little bit more. You can get into the weeds a little bit more on the numbers here. But the biggest thing to know about the pop-up option is that when you pass away, your reduced benefit gets increased back up to the maximum after they pass away. All right, so hopefully that makes sense. Guaranteed period. Don't ever see this one. It has to be very specific. Payment is lower than the maximum. You can name one beneficiary and change them whenever you want. If you die in the first 5-10 years of retirement, depending on the coverage, the beneficiaries will continue to receive the payout. Scenario where this might come in is you retire and you might be terminally ill, and you want to give them a lump sum. You know, even in that scenario, I would probably, it'd make more sense to do the survivor option. I don't really understand too much what the benefits on this one can be. When the period expires, the beneficiary is no longer eligible to receive the benefit. It just doesn't make sense. You know, truthfully, with the guaranteed period, buy a life insurance policy, take the maximum, buy life insurance to pay, and pay the premiums and cover yourself and have more coverage. I don't know. So it is one of the options. I have to go over it for you guys. All right. This is a nice little chart. Should you retire? While you're working, you guys are having, gotta love New York State. You have federal tax, state tax, no local tax. There's pension contributions, your union dues and other dues, FICA tax, Social Security coming out. You have your health insurance. If you're putting money into a 403B or a Roth 403B or a 457, you've got them coming out. Any other deductions like dental or COPA or any of that other stuff that you guys have, those are all the deductions while you're working. When you retire, the only deductions from your pension will be federal, as long as you stay in New York State. Now, granted, all you guys are leaving. All right, everybody's running out of the state because of the damn taxes. Pardon my French. But if you live in New York State and you retire in New York State and you stay there, you do not have to pay state income tax on your pension. It is state tax free. Why do you think so many of you guys go to Florida? Florida has no state income tax. So that's why you guys love Florida, or Tennessee, or Pennsylvania. Pennsylvania doesn't retire income tax, or doesn't tax retirement incomes. But you don't have state, you don't have Social Security coming out, you don't have health insurance to a degree, but you will have some sort. You don't have the 403B contributions coming out. You don't have the pension contributions coming out. A lot of clients that I talk to who have worked 30, 35 years, you guys tend to make more money retired than you did while you're working, because you don't have all the state, the pension, the Social Security, the FICA tax, the 403B contributions. You don't have all those deductions coming out of your take-home pay anymore. You're just getting a check. And usually at that point, you guys see that your take-home pay can be larger, and I've had this on many cases. Your take-home pay is larger than what your take-home pay was when you were working. So these are all some deductions to know while you're working. Other little caveat, which doesn't have anything to do with this, but if you are over the age 59 and a half, in New York State, any of your money that you take out of your retirement accounts that are not a Roth, the first $20,000 is state tax free. Anything above 20 grand a year, you have to pay state tax. So New York State gets you one way or the other. You got to love them. All right. So you have some homework to do. That was my slide. That's all I got for you guys. Counseling session. So big things to kind of consider when you guys are looking to retire. One, is the district that you're working in offering any incentives? If they are, awesome, great. The significance of achieving years of service. As I told you, I won't get into tier 5 and tier 6 right now in terms of retiring and all that, because I'm sorry guys, you got a bunch of years until you guys can retire with a full pension. But the people on this call that are tier 4 or 3, but you retire in tier 3 as tier 4. But anybody who's tier 4, you got to remember that, what was I getting with that? Oh, you got to have the 30 years and 55 or 20 years and 62. At that point, you're not getting a penalty for retiring. You get the maximum benefit that you can for the amount of years that you have. What's the best option for the retiree and your families? Again, these are conversations that I have with a lot of my retiring teachers about what's the best benefit, what's going to maximize your lifestyle in retirement. All right. What's the next step? Start thinking about what you want retirement to look like. I'm starting to do a lot more of this with my clients, where we're ballparking and we're starting to project out what their retirement accounts will look like by the time they retire. Get all your documents, do a counseling session. If you don't work with an advisor who does that, you can call me. But start getting your ducks in order, start making sure that you have everything figured out. Start thinking about the estate plot process of getting your wills, getting your healthcare proxies, getting power of attorneys all figured out. You want to get all that stuff done. You know, you guys busted your butt, worked all those years. You want to be able to retire and basically sit back and, you know, pre-COVID, go on a vacation and go to a beach and do whatever the heck you guys want. Hopefully we're getting close to that again. So let me get back to the questions real quick, because you guys have definitely got some more in here. And then I am almost done for the night. All right, let me see. All right, somebody said, correct. We will make more money retired for now, but if I live to 95, will there be enough money? And they're tier 4. Based off the pension alone, I'm going to be honest, it's going to be tight. It's going to be tight. You want to make sure, and this is to any of you younger people on this call, you want to make sure you take the bull by the horns and you're saving up money on your own into an IRA or a 403B or a Roth 403B, or doing something on your own to help supplement and protect yourself from the inflationary effect of your pension. Because there is a very small cost of living adjustment to the pension, but I am telling you right now, it is nowhere near enough to keep up with inflation. You talk to anybody who retired 30 years ago, they're not making as much as they thought they were going to be making in retirement. So while you're still working, try to maximize, try to put some money away for retirement to help supplement that income. The other benefit, which I talked to in the beginning, is you will get Social Security, which does help. It helps offset some of the costs and some of that, reduction in the pension. So there is that, but you really, as I said, you want that 3-pronged approach: pension, Social Security, and personal retirement accounts or investment accounts. All right. Hopefully that answered your question. Can you also talk about the Roth 403B versus other 403Bs? I can, and I will next month. I see your name. I will email you directly if you have more questions about that. A lot of the districts that I'm working in do offer the Roth, some do not. It's a sore subject for me, but I will definitely reach out to you and talk a little bit more about that. Can you talk about maximizing the pension while maximizing taxes? So this is a tricky thing where a lot of you guys, there's always been a misconception that people tell teachers, and I'm sorry to be the person who rips the Band-Aid off, but if you're walking out and you're making let's say $140,000, $150,000 a year, which is possible as a retiring teacher, and you're getting 60% of your salary, you're going to be making close to $100,000. $100,000 currently would put you in a 22% tax bracket. So your pensions are going to keep you guys in a high tax bracket, which gets me back to the Roth conversation for another day and why that's important, because you don't want to pay taxes at a high tax bracket when you retire. But there's nothing you guys can do about it. Your pension is your pension. Whatever the taxes are going to be based off that is what it's going to be. It's a blessing that you have a pension. You should be very happy that you have a pension. I would give my left leg for a pension. But you also want to supplement that pension with other investments that make sense from a taxable point of view. So hopefully I answered the question on that. When is an incentive worth doing? All depends on your personal situation. It all depends on your finances, whether or not you want to work a couple more years to offset the pension. Again, I see that. I can email you, and if you got questions on that, we can definitely talk about that. I've had people take the incentive and get out, but then they weren't happy because they retired too early. I've had people take the incentive, said thank you very much for the money, and I'm out of here. It all depends. That's a definite personal situation that we can talk about. All right, I think I answered a lot of these. If I missed them, I apologize, but hopefully I answered some of your questions on here. Here's my contact information. There's a picture of me. God bless you. You get to see me there. My email is on there. My cell phone is on there. I'm not allowed to take work text messages to my cell phone. So if you have a message and you want to text me, a lot of you guys working teachers, I get it. You guys are swamped during the day. Text messages is a godsend with you guys because it's the only way I can communicate with you, because otherwise you ghost me and you disappear. So text messages are great. Cell phone, email. If you have questions and you want to kind of dig a little bit more, let me know. I did see one here. How long before you receive your first check upon retirement? If you retire in June, you probably start getting your first check in September, August, September. They do retro it, so because they missed a month, they do make up for that, and you do get that pension check back. Any other questions that you guys have, shoot me an email. As I mentioned before, next month I'm going to talk about the 403B, the Roth 403Bs, and the retirement options. The impact on fees that they have on that, because a lot of people are paying ridiculous fees on their retirement accounts. And then in the fall, I'm taking the summer off on the presentation stuff. But in the fall, I'm going to do Social Security. I'm going to do estate planning. I actually have a economist coming on at the end of the year who's going to talk about the market and where they see the market heading in the next year. So I got a lot of good things still coming up. If you guys have any options or you have some things that you guys want to see, let me know. Last month and the month before, I did student loan forgiveness, and I did one on college and paying for college and the FAFSA and all that. So again, appreciate you guys taking the time. I had a bunch of people jump on this tonight. Thank you. I will send out the videos to the schools for any of you guys who missed it. And have a good night. Appreciate it. Thank you guys.